One group of Wall Street analysts says this stock is worth $125. Another says $600. Same company, same day. That is not a typo. Tesla, the most divisive stock on the planet. And the latest results only deepened the fight. Tesla just sold more cars than in any quarter of its history and made almost no profit doing it. So what exactly are you buying when you buy Tesla at over 150 times earnings? A car company that's stalling, or an artificial intelligence company that's just getting started? That question is worth more than $1 trillion. Stick around, because part 3 is where most people get Tesla completely wrong. Tesla is a $1.2 trillion company, $28 billion of revenue in a single quarter. We'll run this in 3 parts: the bull case that justifies the price, the reality check underneath it, and the chart. Then a verdict, and the one metric that settles it. Let's start with why the believers are so confident. 1. The top line is booming. Revenue hit a record $28 billion last quarter, up 26%. Tesla delivered over 480,000 vehicles, the most it has ever delivered in a single quarter. 2. It's not just cars anymore. The energy business, solar and giant batteries, is scaling fast, with storage deployments up more than 50% in a single quarter. And services revenue jumped 50%. Tesla is quietly becoming an energy and software company, not just a car maker. 3, and this is the whole thesis, the robots. Tesla's robotaxi program is on the road, racking up hundreds of thousands of driverless miles. Full self-driving, the cybercab, and the Optimus humanoid robot are the reasons bulls think Tesla isn't worth $1 trillion. But many. If any of those bets land, today's price could look cheap. Record sales, new business lines, and a genuine shot at owning autonomy. So what's the problem? Here's the reality check. Tesla is making history on sales and going backwards on profit. Look under the hood of that record quarter. Operating margin, the percent of sales Tesla actually keeps as operating profit, collapsed to just 1.4%, down from over 4% a year ago. Operating profit fell 57%. The company sold more cars than ever and earned less on them than almost any point in recent memory. Why? Price cuts to move all those cars and shrinking government credits. Tesla is buying its record deliveries with its margins. Then there's the spending. Capital expenditures exploded 142% to nearly $6 billion in the quarter, pouring money into AI and robotics. That pushed free cash flow negative by over $1 billion. And capex is set to top $25 billion for the year. And finally, the valuation. Tesla trades at over 150 times forward earnings. The average big U.S. company trades around 20. You are not paying for the car business. You are paying in full and upfront for a robot future that hasn't arrived yet. So here's the scorecard. On one side, record revenue, a booming energy arm, and a real lead in autonomy. On the other, collapsing margins, negative free cash flow, exploding spending, and a nosebleed valuation. Believers versus skeptics. For a tiebreaker, we go to the chart. Fundamentals tell you what. Technicals tell you when. And Tesla's chart shows a stock that has come back to earth. From its all-time high, near $500 late last year, Tesla has fallen to around $313, down roughly 37% from the top. Medium term, it's stuck in a falling trend channel, lower highs and lower lows. Momentum is actually neutral here. The relative strength index sits around 55, neither overbought nor oversold. The market, like the analysts, hasn't made up its mind. The levels that matter. Support sits right underneath, around 316, and then a firmer floor near 300. Lose those and there's air below. Overhead, resistance stacks up at 330, then 340, then 348. Tesla has to climb back above that zone before the downtrend is broken. So the chart says, falling trend, sitting right on support, waiting for a catalyst, undecided. So the future or a fantasy? Here's the honest framework. The bull case is real. No legacy automaker has anything like Tesla's lead in autonomy, energy storage, and manufacturing. If robotaxi and Optimus become real businesses, a car company valuation was never the right lens, and the stock is cheap. But the bear case is just as real, and it's specific. Right now, today, you are paying an AI company price for a car company whose profits are shrinking. Every quarter, the robots don't generate real revenue. That gap gets harder to justify. Which brings us to the one metric that settles the entire debate: operating margin. Watch it every single quarter. Right now, it's just 1.4%. If that margin starts climbing back toward double digits as autonomy and energy turn into real profit, the AI story is becoming real, and the valuation starts to make sense. But if margin keeps sliding while capital spending explodes, then you're simply paying a fortune for a car maker that's getting less profitable, and the skeptics were right. Pair a recovering margin with a breakback above $350, and the believers have their proof. Until then, Tesla is the market's biggest, boldest bet on the future, and the highest stakes coin flip on Wall Street. A stock to understand deeply before you ever touch it. That's the full breakdown, the sales, the margins, the robots, and the why behind all of it. If this helped Tesla make sense, subscribe. Every week we break down one company on Wall Street exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet with all the numbers is linked in the description. Quick, but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.